We're joined now by Peter Churchouse, Director at Lim Advisors, live from our Hong Kong studios. Nice to have you with us once again, Peter. We always talk about the negatives of the high price of oil. Where are the positives? How can an investor make a buck out of this?
Well, quite frankly, I've been surprised at how little the equity markets have really been affected by this recent spike in oil prices, which really started about 3 weeks ago, I guess. And even month to date, even taking account of yesterday's falls, global markets are still up month to date so far. For example, the Dow is up just under 1%, NASDAQ up 1.5%, Asian markets are up about 2.3%, and even Japan, up until yesterday, month to date, was up 3.5%. These are markets which you'd expect would be much more negatively affected by oil than has been the case. So my sense here is markets are beginning to factor oil in, and I suspect the markets are beginning to think that perhaps this is not going to be a long-term cycle of $60 oil. It will come down as the economies around the world slow.
Is there any particular sector then that the investors should be riding? I mean, obviously, fingers can point to the oil sector or oil-related commodity sectors. Nonetheless, because they've ridden up so hot, so hard, perhaps they're looking too pricey, and perhaps it's even too late to get in now if indeed, as you suggest, is not going to be a long-term thing.
Well, my sense here, really, quite frankly, you've got to look a little bit wider than oil, even on a short to medium-term basis. My sense here is we should be playing in Asia an asset price reflation theme. We're seeing negative real interest rates in many markets around this region. Asset prices, by that I mean physical real estate prices, are at or close to cyclical lows around most countries in Asia compared to Europe and other Western economies where these prices are at cyclical highs. So I think we are going to see an asset price reflation trade in Asia. And secondly, I think rather than export plays, we're going to be focusing a bit more on consumption plays around the market over the next 12 months or so. So I think we've got to look a little bit broader than just oil and commodities and really start to look at these bigger themes.
Interesting, Peter. Let me take this one step back, though, and refer to something that Michael Metz said a little bit earlier this morning, our US markets commentator. He said that the markets don't fully understand the implications of the high oil price. Could it be that Asia's markets have risen not because they factored it in, but simply because they're oblivious to the detrimental impact that oil prices could have?
Well, I think that's conceited, to say the least. Of course, markets understand what oil prices mean, but we're already factoring in a significant slowdown in economic growth around the world. Globally, this year, growth is going to be something in the region of 4.5%, and that's going to be likely to come down to about 3.5 to 3.8% next year. And we're seeing those same things factored in Asia as well. So I think the markets really are factoring this in. It's not that they're oblivious to it at all. I think they're being very, very astute and factoring up in these slowdowns. And as these global economies slow down, you're going to basically see the demand for oil slow down as well. And that will take the heat out of the oil price spike that we're seeing right now. So I think the markets are being perfectly rational. They're not being irrational at all.
That's a really good point. Essentially what you're saying is that as oil prices move higher, that's going to relieve some demand and essentially bring things back to equilibrium again. I have to ask you this question, though. You talked about asset prices and asset inflation prices a bit earlier. Hong Kong, we had the big land auction. That came in around 14 billion Hong Kong dollars. Most analysts were expecting a little over 10, 11 billion dollars or so. What signal do you think this sends to the retail investor and also the property investor out there who is looking at property in Hong Kong, who say maybe there's a bubble in place because of the rise in prices over the past 12 months, but at this point, by looking at the auction numbers, maybe there isn't a bubble in place. Maybe things are perfectly priced. What's your opinion?
Well, quite frankly, I don't think we can talk about bubbles in asset prices in Hong Kong at this stage. Bear in mind, we've just gone through 5 years of deflation when we've seen asset prices fall between 60 and 70%. So to have a 30 or 40% bounce from 70% down still says we're down 50, 45% or so from the highs. So I think this is going to signal the retail investor is going to be sitting back today saying, well, if the smart money in Hong Kong, which is some of the big property developers who have been very successful in the past, if the smart money is saying, look, we're betting on 20 to 30% price rises over the next 2 or 3 years, why shouldn't I go along with them for the ride? So my belief is that we will see in the short term a pickup in residential property sales and prices. Bear in mind, we've had a bit of a slow summer. In fact, prices have come off during the summer following a big surge in the beginning of the year. So my sense here, this will be the catalyst that galvanizes action back into this market again following a slow summer.
Peter, if you didn't like my previous question, you're absolutely going to hate this one. How much credence do you pay to the theory that oil prices are being kept artificially high by the Middle Eastern countries who are trying to influence the presidential election?
Well, you always get these conspiracy theories around these kinds of events, and if you think back 6 or 8 weeks ago, the conspiracy theory was really attached to the hedge funds. It was the hedge funds that were actually influencing the oil prices. So my sense here is I think that's not the case. We have definite disruptions in supply in places like Nigeria and in the Gulf of Mexico, and also the risk of disruptions in supply in the Middle East. And this is in an environment where demand is running at the strongest level ever seen on the planet. So I think this is a genuine price spike. I don't think it's being manipulated. I think there really is some disruptions to supply which are having this kind of impact.
Peter, always an interesting conversation with you. Thank you very much for your time. Peter Churchouse, Director at Lim Advisors in Hong Kong.